Good day everyone, my name is Ivy Vitor and I am the first reporter of Group A, and our topic is all about analyzing working capital. What is working capital? Working capital is also known as net working capital. It's defined as current assets minus current liabilities. It tells the financial statement users how much cash is tied up in the business through items such as receivables and inventories, and also how much cash is going to be needed to pay off short-term obligation in the next 12 months. Working capital formula is current asset minus current liabilities. The liquid fund to current recurring expenses. Working capital is a measure of a company's liquidity, operational efficiency, and its short-term financial health. If a company has substantial positive working capital, then it should have the potential to invest and grow. If a company's current assets do not exceed its current liabilities, then it may have trouble growing or paying back creditors, or even go bankrupt. Working capital, also known as net working capital, is the difference between the company's current assets, such as cash, accounts receivable, inventories of raw materials and finished goods, and its current liabilities, such as accounts payable. Net operating working capital is a measure of a company's liquidity and refers to the difference between operating current assets and operating current liabilities. In many cases, these calculations are the same and are derived from a company's cash plus accounts receivable plus inventories, fewer account payable and less accrued expenses. The purpose of working capital is to ensure that bills can be paid when due. This is necessary because the timing of inflow is typically different from those for outflows. Nature of capital investment analysis. Capital investment analysis is a budgeting process used by businesses and government organizations to evaluate the long-term profitability of a project. Long-term investments, such as equipment, machinery, or real estate, are evaluated using capital investment analysis. The expenditure of money to fuel a company's long-term growth is known as capital investment. The term is frequently used to describe a company's acquisition of long-term fixed assets, like real estate and equipment. Capital investment funding can originate from a variety of sources, including cash in hand, although a large project are typically financed through loans or stock issuance. By definition, a venture capital firm is source of capital investment. Understanding capital investment analysis. Capital investments are risky since they entail large upfront outlays on assets that are expected to last for several years and will take a very long time to pay off. One of the most basic criteria for a company evaluating a capital project is that the investment return exceeds the hurdle rate or needed rate of return for its shareholders. The purpose of this procedure is to choose the alternative that will provide the best return on investment. Capital investment analysis can be done in a variety of ways, including assessing the estimated value of future cash flows from the project, the cost of financing, and the risk of the return of the project. Methods used in evaluating capital. Every company will have to review capital investments initiative at some point. Expansion of output, replacement of aged equipment, and a variety of additional solutions are all possibilities. Available finances, whether from cash on hand or borrowed funds, can be restricted. Therefore, firms must carefully consider their investing possibilities. Long-term investment in which the assets involved have a useful life of several years are known as capital investments. Capital investments include things like building a new production facility and purchasing machinery and equipment. There are many tools available to evaluate capital investment projects, but each tool has advantages and weaknesses. As such, each project should be evaluated using all available tools to get a better sense of the full impact of each project. Ideally, a business would invest in all projects with a positive NPV and IRRs above their hurdle rates. However, businesses often have limit funds and must be able to properly evaluate the projects available to them and decide the best forward given their current funds and business goals. Average rate of return. The average yearly amount of cash flow created over the lifetime of an investment is known as the average rate of return. The rate is computed by multiplying the total predicted cash flow by the number of years the investment is anticipated to last. Investors frequently use it to choose whether or not invest in a particular asset. The formula for the ARR, or the average rate of return, is the average annual net earning after taxes over the initial investment times 100%. The average rate of return is a way of evaluating the profitability of several options throughout the anticipated lifetime of an investment. It does this by comparing an investment's average annual earnings to the investment initial cost. This is required in order to compare investments that may last for various amount of time. A business will first compute the average annual earnings to determine its average rate of return. Average annual profit equals, to get the average annual profit, the formula is the total profit over investment period divided by number of years. So this is an example of ARR. Fly High owns a business that transports breakfast to offices across much of southwest Cornwall. The business is growing and wants to invest more money in either buying another delivery van or upgrading the storage space for food at the current facilities. Mustafa has a budget of 40,000 euro and can only choose one option. The following information is available for each of the options. So, as provided here in our PPT, it has a year 1 to 5, and the choices are the new delivery van or upgrading to a storage space. So here are the solutions on how they get the average annual net earnings. So in the new delivery van, they add they sum the total of the year 1 to year 5 and divided it to the estimated life of 5 years, in which it has a result of 14,950 as the average annual net earnings. The average annual net earnings is divided by the initial investment, which is 25,000 times 100% to get the ARR. Same goes with the upgrade to storage space. They add the year 1 to year 5 and divided it by the estimated life, which is 5 years. The average annual net earnings for the upgrade to storage space is 13,500 divided by the initial investment, which is 35,000 times 100%. The result for the ARR of upgrade to storage space is 38.6%, and the result for the new delivery van is 59.8%. Therefore, new delivery van should be chosen based on the calculation since it has the higher ARR. And also, note that in ARR, it doesn't matter whether who has the larger initial investment. What matter there is who has the higher ARR, or the average rate of return. So this concludes my report, and the next reporter will continue our topic. Thank you.